5 mistakes that beginner investors make. That's what we're talking about on this episode of Beyond the Stock Price. Hello investors, my name is Devrhoid Davis and welcome back to the channel. I'm lucky to have been a part of a lot of stock market investing groups on WhatsApp and Telegram. I'm also lucky to be in the position where persons will reach out to me if they have questions about particular stocks. In this video, I'm going to be going over 5 mistakes that I see beginner investors make all the time. And I've made all 5 of these mistakes, so I can tell you I'm an expert on all of them. Number 1, not investing in their financial education or not investing in research or getting information. When I first started buying stocks in 2013, I had absolutely no idea what I was doing. Now, my mentor had already shown me the Jamaica Stock Exchange's website, but on a fundamental level, I truly didn't understand what the stock market was or how the stock market really worked. I bought my first stocks literally the day after I listened to Robert Kiyosaki's Rich Dad, Poor Dad. I never read the book, I just listened to the audio on YouTube. Speaking of, the link to the book is actually in the description below. So if you guys want to check that out, those are my affiliate links down there. So after listening to Rich Dad, Poor Dad, I decided that I was going to buy stocks since I was not able to buy a rental property. So I ended up buying my first block of shares at basically an all-time high. I also ended up paying some of the highest brokerage fees within the industry at the time. Some of you might even be able to tell which investment house I was with at the time. So you guys can actually leave your thoughts about that in the comments and I'll tell you if you were right or not. Had I devoted a little bit more time to researching the stock market, to researching the company that I was buying shares in, and talking with different brokerage houses to kind of get what the going commissions were at the time, then I probably would have been able to buy those shares at a significantly lower price per share when you take into consideration all of the fees, and I would not have made such an expensive mistake. Fortunately, my pain is your gain, because since making that mistake, I have written numerous articles on beginner investing on Caribbean Value Investor, and I've published a whole lot of videos on the different concepts that you might encounter when you actually begin investing. I even wrote a book for beginners in the stock market. You can pick up a copy at the link in the description below. The second mistake that beginner investors make is not talking to a licensed financial advisor before they decide to invest. Now, I know there are those, particularly on Twitter, who claim that financial advisors do not offer any meaningful service. Personally, I firmly disagree with this. I could make an entire video talking about the importance of talking to a licensed financial advisor before you begin investing. But to kind of keep it simple, I'm going to give just 3 reasons why you ought to consider talking to a licensed financial advisor before you consider investing. The first reason is that financial advisors typically have some level of financial information that the general public doesn't have or otherwise don't employ. That is, they may know it but they don't utilize it. A simple example could be that of making a budget. So many people might know that they're supposed to make a budget, but a licensed financial advisor is going to sit down with you and have you actually go through the process of creating a budget. The second reason is that a licensed financial advisor is able to give you information on a wide range of financial products, such as stocks, bonds, unit trusts, insurance, etc. Sure, you might want to be getting directly into stocks, but it is possible that after you speak with a licensed financial advisor, you might come to recognize that stocks isn't the ideal investment option for you based on your current situation. A financial advisor is going to be able to help you to get clarity on which investment product is best suited for you at that particular point in time. Lastly, a licensed financial advisor is going to be able to help you to identify your risk appetite and to come up with an investment philosophy that suits your demeanor or character. I talk about the importance of knowing your risk appetite and having an investment philosophy in all of my masterclasses. If you guys are interested in joining one of my virtual sessions, then you can reach out to me either in the comments or you can send me an email at devrhoid.davis@caribbeanvalueinvestor.com or simply devrhoid.davis@yahoo.com. Mistake number 3, not having a financial goal. If you make the first 2 mistakes, you're likely going to be guilty of this one as well. I know I was. So let's talk about goals. So what is a goal? When I first started, my goal was to double my money. That was the goal. I later learned that that was actually not a goal, and that a goal is only a goal if it meets the SMART criteria. We call them setting SMART goals. It was only after I learned this that I learned that saying I want to double my money was not a goal. And you say, really? Yes, really, it's not a goal. So what is a goal? I learned that a goal must be specific, it must be measurable, it must be attainable. So for example, I learned not to set goals that I wasn't qualified to attain. And we can talk about that. I'll talk a little bit more about setting SMART goals and the goal setting process in general over on my personal channel, that's Devrhoid Davis, and it's going to be linked right here, as well as it's going to be in the description below. Next, it must be realistic. It's good to be lofty with your vision, but I learned that if I set more realistic goals, that is goals based on data and information, then I was actually more likely to achieve them. And lastly, I learned that goals should be time bound. That is, they must have a timeline to them. I must have a time frame in mind by which I should achieve the goal. Your financial goals must also be SMART. They must be specific, measurable, attainable, realistic, and time bound. If your goal does not meet all of these 5 criteria, then you really don't have a goal. Notice that this goal is specific, it is measurable in that it tells me how much I want to make, it is attainable for me based on my skills and my experience within the market, it's realistic because it's actually based on data that I've compiled over the last 3 years, and it is time bound because it actually does state by when I'm hoping to achieve that goal. Remember I said that when I first started buying stocks, I didn't have any goals, and that's because I didn't really know about the criteria for setting goals and so on and so forth. And so this is another mistake that I see a lot of beginner investors making. Guys, so I'm disrupting the regularly scheduled program to make an appeal. I've been checking out the channel's analytics and I've come to realize that literally 60% of my viewers are not subscribed. That's 6 out of 10 of you guys who are watching this video are not subscribed. So guys, here is my appeal. If this is your second or third or even your first time visiting the channel and you find something valuable on the channel or from the presentations that we've been giving, I'm going to ask that you just kindly click that subscribe button. It really does help out the channel. We have a lot more content coming and it's encouraging to see those numbers actually going up. So guys, that's my appeal to you. If you're liking the content, if you're learning something, if this is your first, second, third time to the channel, just click that subscribe button. I promise you it won't cost a penny. And now, back to the reason you clicked on this video. Mistake number 4, having unrealistic expectations. And again, I've been very guilty of this one myself. if you don't have historical context of the markets and you hear on the news or in passing that X stock has gone up 100% in a week, you might be tempted to think that these are normal returns. The thing is, they're actually not normal. On average, the market returns around 8 to 10% per year, corrected for inflation. Now, of course, you have those years when the stock market does really well and will return, say, between 15 and 30%. You also have exceptional years, such as 2015, when the Jamaica Stock Exchange went up by 100%. What that meant is, on average, all of the stocks on the JSE in 2015 appreciated by 100%. So if a stock started out January at $50 per share, it basically ended December at around $100 per share. Again, I'll link to some articles in the description so you guys can actually read up on these things. Again, these are not typical performances of stock exchanges, and it's certainly not realistic to expect that this is how your investment is going to perform once you get into the market. Furthermore, there are years when stocks, bonds, index funds, or even real estate are hit by social, economic, or environmental factors. We're currently facing a health crisis, and it's anticipated that the hurricane season this year is going to be even more brutal than it has been in the past years. All of these things come together to actually affect the performance of financial markets, and stocks are no different. Speaking of unrealistic expectations, let me go back to my original expectation when I first started investing. Remember, I said that my goal was to double my money. Well, had I spoken to a licensed financial advisor at that time, they would have told me that the Jamaica stock market had basically been lackluster, that is, it was basically flat for the 2 years prior, which would have been 2012 and 2013. And they would have also told me that were I patient, I would have been able to even get the stocks that I bought around 45% less than what I bought them at. Mistake number 5, the last one on our list. Number 5 on our list is investing too much, or its opposite, investing too little. Even if you become an astute student of investing, you are still susceptible to making mistake number 5. Mistake number 5 is more psychological than anything else. So in my own experience, there have been times when I've gotten very unique opportunities. I've had all the information you could possibly need in order to make the investment decision and to go heavy on a particular stock, and I didn't. You're more likely to make this mistake when you've just started out. That is, when you're a beginner. And the reason is because psychologically, most of us are hardwired to avoid risk. On the other hand, there have been times when I've heard about a hot stock, or I've heard about this investment, this can't miss investment opportunity, and I invested way too much than I should have without even doing the proper due diligence. This actually happened to me in one multi-level investment opportunity. I invested a whole lot of money into this opportunity and ended up losing literally all of it. Well, investors, that's it for this episode. Tell me, did you guys make any of these mistakes when you started investing? Did I miss any major mistakes? Share your thoughts in the comments. Oh, and don't forget to like this video. It really does help out the channel. And for each of you who actually put a like on the video and leave a comment, I'll be sure to leave a heart beside your comment. Lastly, you can check out some of the other videos on this channel, as well as you can check out my personal channel, Devrhoid Davis, where I have some kind of longer length videos, as well as I'm sharing stuff along the lines of personal development, business and entrepreneurship over on that channel. So guys, again, thanks for watching, and I'll see you guys in the next video.